Good evening. Ira Epstein of Linn Associates with your financial market wrap-up for this Tuesday, the 19th of January, 2021, about 6:10 p.m. The important event tomorrow, of course, the inauguration. But there's other events. You got the Bank of Canada's monetary policy decision, their CPI, and I think the UK's got their CPI coming out. So there is some important data coming out besides our regular economic data, and we do have quite a bit of that in the morning as well. But the market's going to be enamored, and you know that with the inauguration, we got our fingers crossed that nobody tries to damage anything, make chaos out of it, be it in Washington, D.C., where we have the equivalent of a division of army there. I think there's 25,000 troops there. And then what about the state capitals and the cities? I know that in Chicago, they've closed City Hall for tomorrow. A lot of the public spots are now closed. So we're ready for whatever's going to happen, they say, but just multiply this across America. So you understand. That has given gold a little bit of a bid, the same in the Bitcoin. I noticed today also that the Russell was falling behind in gain on the other indices. Now, I don't know if it's a catch-up part of the market, because that has been the leader, but I noticed it today, and I took action because of that. It was very evident. The other thing I'm watching is the dollar's getting weaker. We saw Janet Yellen speak before the Senate Finance Committee. I think it's Finance Committee. It was that or the banking. I don't know which one it was, but I watched the whole thing. And to make a long story short, I think she did a fine job. She made it very evident. She's on the Biden team. She's all for this $1.29 trillion stimulus. People need the money. She'd rather overshoot than undershoot. It's easier to rein in inflation than to fight deflation. It's pretty clear as to where it's at. If you read her words, it made it very, very evident. She's for the people, for those not being served the right way. Read it. It's in my newsletter, and I took her own words in it. Bonds and notes sort of flat. Energy market staying well bid. Why not? The market is looking at a situation where we've got a cutback in production, and while IEA says there's going to be reduced demand right now, for the whole year, they look for only 300,000 barrels reduced demand. That's not so much. And remember, all the cuts that they made in OPEC and the like, they can ratchet up a little bit as everybody comes out of COVID, whenever that's going to happen. So as I take a look at the S&P, the market is right now up 37 points, 1% for the week, knocking on the door of the all-time high close. Not there, but knocking on the door of it. When we take a look at the daily bar chart, we take a look and put the swing line on. It's funny because you got lower highs, lower lows, which is a downtrend. It's fully countered because the market is trading over the 18-day average of closes, which means the bias is up. When the swing line is down and the bias is up, the two nullify each other. Where else has the market been making a stand over and over? And you've got to pay attention, I think, to this. It continues to be that 18-day average. You've got to keep your eye on it. One of these times, you're going to get under it by more than you think, and that'll be a sign a correction is underway, a real correction. How deep it'll go, I can't begin to tell you, but that's what I'd be looking for. Until that occurs, I just view those as opportunities where the bulls are stepping back in the marketplace. The resistance is the 38.41 level, the upper Bollinger Band, but remember, you've got the swing line down, the bias up, and you have an overbought market. A market that if the market were to close just like this, it'd be the first day of trying to embed, because you had lost that back here, and the market did make its run to the 18-day average, did just what it should, and now the market can decide, does it want to embed again? If it does, I'd look for new contract highs, but I'm waiting to see what it does. In the NASDAQ, it's similar. The market has gone sideways for the longest period of time. It has done very well in respecting this 18-day average and staying over it. That's crucial because it keeps your bias to the upside, and it keeps one, if they have a trend and then a bias and the two fight each other, they're not complementing each other. They're saying, no, you don't do anything. That's what's been going on. And I just wait to see what the market's going to do. We are overbought, not trying to embed. In the Dow, similar. You had lost the embedded reading. I'll take you right here. You go down to the 18-day average of closes. That's all I'm looking for in the market. And the market is marking time. It too, though, has a situation where it's not embedding. It's not trying to. So while the S&P is, this isn't. And the Russell's been the strongest with the embedded reading. But suddenly it's just pausing. It's not making its run again for the upper Bollinger Band. I recognize that. So what I often do in markets like that is I'll tell my subscribers, you can do a bit of liquidation, keep a core position, and that gives you opportunity if it wants to slip down and keep this embedded reading. And if not, you've gotten out in this area very nicely. You're never going to get the top and the bottom. The idea is the middle. If you don't believe that, terrific. The whole marketplace is littered with people that think they can get in and just catch the whole thing. And I wish them the best if they can. I'm sure some have, but we'll see. My experience has been most don't. In the VIX cash, you've still got a market that's got the swing line up, but prices now closed back today under the 18-day average in a sideways trend. We get those blips where it comes up, but it doesn't stay over that band. It's basically a sideways market. And what it's really done is last year we had a market that was trading, I don't know, probably between 13 and 18 or 20. Now it's ratcheted up to trading between 20 and 26. That's the difference. So it's built some caution into the market, but not like it was before, where basically you didn't need insurance for anything, is what the market was saying. Different this time around. In the bond market, you have an oversold market in a downtrend that, while it had its big run, once that ended and you got to the right-hand side of the Bollinger Band, you've just drifted sideways, almost void of a trend. In the 10-year note, you are void of a trend. You have a higher high pattern, there to there, and lower and low. The market's got a bounce going, and similar to the bonds, you were underneath the Bollinger Band and you came ratcheting back. You had 1, 2, 3, 4, 5 days under. In futures, that's like pulling a rubber band, let it go, and the market comes back at you, but that does not mean that it's changing its trend. In the dollar index, up to the upper Bollinger Band on Thursday and Friday, and right back down today. And it'll probably, from what I'm seeing in the euro, be a bit lower in early trade as the euro is up about 12 points. Remember, the eurocurrency makes up 40% of the weighting of the dollar index, so you always look to see what's that doing in relation to it. But is the euro doing anything? No, it's an oversold market in a downtrend with downside bias that is bouncing and not much more than that. I do not believe that when you're oversold, you attract new money into the market to go short. You can do that when you're not oversold or embedded. I don't believe it's when you're oversold. In the British pound, it's waffling, just waves of up and down, basically keeping itself in an overbought condition, as you can see. I wouldn't know what to do with that. I wait for easier times to trade than trying to make something basically out of nothing. In Bitcoin, you can see you still have the higher lows, higher highs. However, you did lose your embedded reading. You have never challenged this 18-day average, and the fact that it keeps moving higher each day means that from when it was lost, the shorts that are playing that, they'd have a stop probably over that high. They have a shot of getting their money back, and that's about it as I read it. Momentum pointing to the downside. This is probably the most overcrowded trade now of the sectors that are out there. That's what I keep hearing on CNBC. They keep talking about that. In Brent versus WTI, you peaked out at 372, you went back down near 270, and now you're getting a little bounce in the market. What are we doing in this market? You lost the embedded reading in the Brent. When you lose that, I don't think you want to be playing hero time. It's time to be sidelined, let the market figure out what it's going to do from there. That's my attitude on it. I'm not bearish, but I'm certainly not bullish. And because of that, I don't know what to do with WTI. The trend has been down. The market should be hitting if it loses the embedded reading, which it hasn't done, the 18-day average. So it's getting bought on these breaks, and I get it. Doesn't mean I want to have my clients trade it, but I'm watching it right here. In the heating oil, this I'm more bullish than I am the others because we still have winter in front of us. Natural gas is the market that's taken the beating because we just don't get that real cold weather. This is climate change. This is La Nina that you're feeling. And during that, you can have milder weather. Yes, I know some parts of the country are in their 20s and 30s, but we're not in deep freezes anywhere. And that's the importance, because you're not burning as much fuel as you might use to keep yourself warm when it's sub-zero. And you can see heating oil getting a bid, but nothing great, and the nat gas just marching around. Now, one of the things that I want you to take advantage of this year, if you'd like to, is the free offer to try my research. I write twice daily market reports. I do them like a Reader's Digest. I give you all the headlines that are coming out, the initial reactions, then a paragraph of my commentary. Why not longer reports? And they're meant to be read in just a couple of minutes at the most. The reason is the guts are in this. My morning subscriber videos where I talk the chart action. And when I'm showing those charts in a 20-minute video, I can do a heck of a lot more than writing a report and burying you in pages and burying myself, where basically you're just a writer. I cover the window envelopes, moving averages, slow stochastics. I will talk at times accounts that come up on markets, Fibonacci ideas that some traders might have. I put it all together trying to give you a game plan. How do you get it? Simply go to our website under free offers. I want to give it to you again if you've tried it even before. It'll be a short period of time, but you should take a look at it. And you can always call my staff. They'll have you set up like that. I'm Ira Epstein. Take advantage of this. I'll see you tomorrow. Should be an interesting day. Take care.